got a thumbs up on the audio visual, so welcome everyone. I just want to say thank you to everybody. I'm Joe Cicala. I'm the founder and CEO of the Dream Exchange, and we're keeping our webinar series going. It's been very meaningful to people who are following our progress, and today is a little different because in the past I've really talked frequently, and I say there are harmful effects to not having an exchange auction marketplace. And I don't really define what that means. So in today's webinar, we're going to go through some very specific details on what it means to have a regulatory marketplace that is really helpful. And one of our major goals, in fact, I think it's ingrained in our mission, which is we really want to develop this marketplace. It's called the Venture Exchange Marketplace. I'm not exactly a big fan of the word venture exchange because people equate it with venture capital. It's not really venture capital. It's a marketplace for small companies, custom designed so that we can create the optimal environment for trading rules and being able to create a liquidity market for small companies that want to be public. So actually, and in line with that, one of the things I'd like to do, and I do this at the beginning or at the end of our webinars, which is to actually articulate a little bit of the video. It shows off our marketing team's capabilities too. So I have a video that I'd like to show you, especially as people arrive to the room, that really articulates our purposes and what's really behind what we're trying to accomplish. So, and this one is, now we have we're in a new office. We're adding a lot of people in anticipation of our future launch. So we're in brand new quarters. We're adding staff. Pretty soon we're going to have we're going to have growing pains with where we are too. Right now I have a tech team. They're going to play the video for you. It's going to start in a second here. And as soon as that starts, you can start at any time. I think they can hear me. And the truth is that 120 years ago, you couldn't travel to the store without a horse and a buggy. You couldn't travel interstate without getting on a train. And since that time, well, clearly no one would consider taking their horse to the grocery store. You get in a climate-controlled vehicle. We live in a technological society where we have wireless communication that never existed before. We've changed the way human beings live on Earth in such a profound way. And the reason that innovation came to be is because capital markets supported the most imaginative ideas. We gave our money to things that would expand our ability to survive by supporting others who had brilliant ideas and great imaginations, and we've all been better off for it. And it is across all diverse marketplaces, across all people everywhere. And we're concentrating on developing markets in areas where the greatest ideas are in fact born. And we want to get them access to the money they need to expand them. That's really what the Dream Exchange is all about at its core purpose. Okay, so I think that gives you a background and a setting, and this is a lot of mechanics in this presentation. So, the first thing we're going to cover, and I think this is important for everyone to see. So, what are the features of just in general exchange marketplaces? And we're concentrating here on the go public decision. The initial public offering decision is something that's a very significant decision in a corporation's development. And what does that mean? And how does that make a difference for that company in terms of what it's going to be required to fulfill, what promises it has to fulfill, and what are the regulatory constraints to doing that? And we're going to go over some differences between an exchange marketplace and a non-exchange marketplace, and really help outline the differences in a different way than we've done before. By the way, we really appreciate your feedback. It actually informs us for future webinar topics and things that we want to discuss in the future. So, anything you have that questions, and there'll be a question and answer period at the end here, but some of these topics have been driven by questions and things that have come up prior that really we want to give a full breadth of information to about what it is we're really developing. And finally, what is it that exchanges can provide in terms of stability during times of volatility and market crisis? And, we have these events. There's a popularity right now. Actually, we did a webinar last year when GameStop and other sold stocks were experiencing short selling. We did an entire educational video on what a short sale is. This is a little different because right now all over the news is Silicon Valley Bank. So we're going to have a brief discussion at the end as to what an exchange offers in terms of market stability during times of these crises. So first and foremost, what are the features that exist within an exchange marketplace? So when you see this particular diagram, these little boxes, each one of these boxes could be a multiple hour webinar in and of itself. But let's just start with this concept. There's a stock issuer. Now, today, to raise money in America, there's only, at a high level, there's only two ways to do that. There's only two ways to sell stock in our country. One is to file a registration statement and be public, to go public with the SEC. Everyone's familiar with this. IPOs, the famous Facebook IPO, and when you hear about an initial public offering, initial meaning the first time, public, available to the broad investing American public, an offering, well, the company is now offering its shares. That's IPO, right? Well, an IPO has to have a stock issuer, someone selling the stock. So the first way you can sell your stock is register those shares of stock with the Securities Exchange Commission. The second way is to be exempt from registration. There's about 18 different ways to be exempt. If you're not exempt, you have to register. So it's binary. You're either a registered security and you can sell it to anyone, anywhere, at any time, or you're exempt for registration, which means you're a private company. If you're a private company, you cannot sell the stock to anyone, anywhere, anytime. It's a select group of people, and you have to pre-qualify them. And there are laborious steps and a labyrinth of rules required that you have to comply with to raise your capital as a private company. Another detrimental feature is once they buy the shares, there are constraints on the resale of the share. In other words, it's still a private share of stock, can't be resold. So what we're concentrating on here is what are the features of the public market, but more importantly, a public market, meaning a registered share of stock, exists in an exchange environment. And this is an extremely important distinction. Not every public company is eligible to participate in a stock exchange. There are requirements, there are rules. You have to apply for the license. So if you see the diagram, you see where it says, in the purple box, it says SEC registration. There's a series of documents. If it's the first offering of a stock, the nomenclature of the document is Form S1. It's the first time you're going to sell stock and make it available to the public. You have to file that document with the Securities Exchange Commission. Simultaneously, you have to apply to be accepted by a stock exchange. So there's an application process. Now, in the largest investment markets, usually the SEC registration is accompanied by an enormous amount of work being done behind the scenes by those who would sponsor the investment banks, attorneys, accountants, stock analysts. There's an enormous amount of work going into the registration process as well as the application process. But a stock exchange doesn't have a lot of heavy lifting where it's a very large company, because all the work is being done to be given to the Securities Exchange Commission. And therefore, the stock exchange in the application process can piggyback. They can take the work done by others for that initial registration and use it to determine eligibility. And usually, if the documents are compliant and the company meets the minimum listing standards for a stock exchange, they'll accept them. However, there's a certain amount of due diligence. The stock exchange has an obligation to make sure that that company is compliant. They can't just take everyone's word for it. They have internally their own initial public offerings department, which verifies the information that's being given by everyone. Now, registration isn't automatic. After there's a registration statement filed with the Securities Exchange Commission, their regulator and enforcement departments comment. And the comments can be quite serious. It's an SEC comment is usually something that, if it's not cleared, if it's not handled, then the stock is never eligible to be offered to the public. So there's this comment period where the SEC reviews and makes sure that there's compliance. Now, a stock exchange during the due diligence process is doing something very similar, albeit it's a binary decision. Either there's a pass-fail. If the company applies for exchange listing and it passes the minimum requirements, then it enters a phase of public company reporting and compliance, meaning leading up to the IPO, leading up to the first day the shares are sold, there's additional compliance, things that are called bring down certificates, and attorney's opinion letters, and final updated audited financial statement information. There's a whole lot of work that goes into a very short condensed period of time, including oversight of how the marketing of that initial public offering will be done. So if they pass exchange due diligence and they pass the Securities Exchange Commission comments and they get through that next phase leading up to the IPO, they get a green light and now they can sell their shares. They're in an exchange listed environment as an IPO. However, what happens after that is of extreme importance. While they're still governed by the Securities Exchange Commission as a public company and FINRA, they're also governed by the exchange. And their exchange is assuring that there's compliance with listing oversight and trading and reporting. In other words, while the company has offered its shares for the first time for the privilege of continuing to resell shares in the public market, they have to also continue to comply. They have to transparently report information every 3 months, which is a tremendous burden. On the other hand, it makes the market trustworthy. So once the IPO is complete, what is called secondary trading, the next sales, they go on and on and on. In fact, every year, there are 3 trillion trades executed, executed every year, not trades. 3 trillion shares change hands every year in our national markets. Okay. One trade could be 100 shares, but it's still 100 shares have to transact. That's an enormous marketplace. 3 trillion shares trade and change hands every year. So the regulation over this marketplace is very detailed and very onerous for good reason, because the investors in that market don't want to get ripped off. And neither do the good companies. The best companies in the world want a transparent, fair, trustworthy marketplace, because if they're a good company, it works to their advantage. Works to their advantage because people then can more easily be willing to buy and sell those securities at whatever price, under whatever constraints they want to sell them in for any reason or no reason at all. So that compliance is ongoing. And as long as they pass, they continue to trade. See that pass to the green box, trading is permitted. They keep trading. If they fail, they can be delisted from the stock exchange. That's the most severe penalty. Now they can get warnings, they can get letters, they can get market regulatory compliance from the exchange reporting to the company, hey, you're not in compliance. Get your act together or we're going to penalize you. In fact, exchanges can fine a listing. So there's all different ways that compliance and oversight of an individual company takes place within a stock exchange marketplace. And that red box is where a company does not want to end up there. They do not want to end up not eligible for trading on exchanges. So there's a tremendous incentive to continue to be compliant, not just because there are rules and laws that the Securities Exchange Commission oversees, because fine, the bare minimum is don't break the law. On the other hand, compliance allows them to have a trustworthy marketplace where people can trust the value of their shares being traded, fully informed. The investor gets reported information to be fully informed on an equal basis with all the other investors in the market, so investors can decide buying and selling on an equal playing field. So that not eligible for trading box is an extremely dangerous zone for a company to end up in. Now, mind you, they can end up there just by not being eligible to begin with, and the exchange does its due diligence and, thank you for your application, but I'm sorry you're not eligible, it is absolutely something that is heard on a more frequent basis than one might believe. It's not automatic. You're not automatically eligible just because you filed a registration statement to have your company's shares listed beside the other companies on, for example, the New York Stock Exchange or the NASDAQ Stock Exchange, which are the two primary exchanges that accept listings. Our future development includes changing rules in the future to allow us to accept listings in a new way, in a way that might be a little bit more flexible than New York Stock Exchange and NASDAQ, and perhaps seeking out, as you heard in the video, we're looking for new markets. We're looking for places to go to find listings perhaps that haven't been explored before. Now, what's really important about what you're seeing here is a differentiation and understanding of what is called the over-the-counter markets. Now, the over-the-counter markets are very different in this process. So over-the-counter to many people, it tends to mean a public company. Well, not exactly. It is a public company, that's for sure. But you see the line here. So a company prepares their registration. They prepare similar documents. However, when they file their registration, many companies that are just staying on the over-the-counter market that know they're not going to be eligible to participate in a stock exchange environment. Well, once they file their registration and they're approved, the SEC says, yes, everything at the outset is correct. Well, once that happens and they're over the counter, they can be made available as a share offering through a brokerage. The over-the-counter market, or OTC markets, is a stock brokerage. It's not a stock exchange. They concentrate in making available and making others open to the possibility that they might be able to buy stock in a company that hasn't reached an exchange yet. So there's a certain amount of liquidity, certainly. On the other hand, On a regular basis, there's no regulatory oversight. The stockbroker, the over-the-counter brokerages, have no obligation to assure compliance with anything. In fact, many of the over-the-counter market securities, they used to call them the pink sheets, well, they're not compliant. Why were they called the pink sheets? Well, I'm going to date myself a little bit here. In the past, when documents were being filed manually, literally all the paper documents were being filed, at some point or another, when a company fell out of compliance at the SEC, they would put a pink sheet on the top of the filing. The pinks were people that did not actually have full compliance with securities regulations. Now, did it mean it was a bad company? Not necessarily. Falling out of compliance can be more meaningful in some contexts than it is in others. However, at eligibility, when a person comes to a stock exchange and the SEC, they perform background checks. You can't have been someone, for example, who committed securities fraud and easily get through. You might be able to get through the process, but they're going to ask. So there's a background check on the owners, participants, shareholders, management teams. That happens in the slide I showed you to begin with, but that doesn't have to happen here. Many of them don't have audited financial statements. In fact, ongoingly, that's one of the primary things that tends to fall off with a very small company. They're not compliant with filing fully audited financial statements. There's no review of board compensation. It's another really important feature. Whether the board of directors that controls the company is able to share profits or take working capital out of the company for their compensation or pay themselves in a way that might not necessarily align with the corporate goals. Well, in traditional IPO with the grayed out boxes, there's a period of time where board compensation is reviewed, corporate policy is reviewed, Sarbanes-Oxley compliance, which is a law that says that if there's crime within your organization, those who sign statements can be held criminally responsible. No obligation to comply with the Dodd-Frank Act. The provisions of Dodd-Frank are actually too numerous right now to go into, but suffice it to say that it's a fairly lengthy series of laws that were enacted during financial crisis time that provided for protections for the investors to make sure that there was integrity to the financial preparation and statements that companies made to the market. And outside of the individual company, there's no regulation national market system. That's what NMS stands for. So national market system has marketplace rules. Those rules actually govern exchanges and how and when an exchange should be obligated to make sure that it is enforcing its own rules over the companies listed. So what you see here is a very quick and direct line, and it is a stock brokerage environment, not a stock exchange environment. And very quickly you can see without this verification or check and balance in the market, you can occasionally get companies that some of them are outright fraud. Okay, there's actually been in the recent last 5 years for sure a tremendous attention at the Securities Exchange Commission in their Department of Enforcement suing issuers for committing fraud. In fact, many fraud enforcement actions have been occurring in the OTC markets to clean up those marketplaces and to make them a more trustworthy marketplace. But once again, without exchange oversight, we're left to the government filing lawsuits or private citizens filing lawsuits that reach all the way down to way below minimum on compliance, where people are actually getting away with fraud. If you've ever heard the expression pump and dump, that's a technique used in the over-the-counter markets all the time. It's where people are able to manipulate the price of the stock, pump the price way up, and then sell at high prices while gradually just dumping it, having made all their profits. It's actually against of a whole series of very good regulations and laws which are designed to protect the investing public from the unscrupulous. Now, there are more attendant problems with this, okay? But the point is that over-the-counter is an enormous difference than exchange listed. Those two types of registered securities bear almost no relationship to one another very often. Now, that's not to say that there aren't very good over-the-counter stocks, that market isn't useful. I've used it. I've actually taken companies and got them registered as over-the-counter companies, only later to see them graduate to an exchange listing on the NASDAQ or the New York Stock Exchange. It's one of the primary reasons that we're doing what we're doing at the Dream Exchange, is to use a similar technique. However, instead of having an over-the-counter marketplace where a good, solid, credible company has to be lumped in with many, many other companies that are not necessarily as compliant, well, now you've thrown in good companies with the bad. There's an expression that I've been using recently, which is that we are wait. Okay, so sorry, I'm making sure my tech team can hear me. Okay, so the fact is that the distinction between an OTC company that's really compliant and is a good company and a company that's not so compliant is an important distinction. Now, this is the public marketplace. So it's a wash with trying to differentiate good from bad, let alone risk from reward in any investment. The other way I talked about is the private markets, right? You can sell shares in a private market. Distinguishing private companies is even more difficult. And the fact is that, and hopefully you'll appreciate my cartoon here. In the private markets, there's a stock issuer. And they're issuing stock, but they're exempt from registration. Remember, I was saying, if you don't file a registration statement, well, you have to comply with a series of laws that really make it, that you can be caught if you've done something wrong after the fact. But there's no oversight assuring that you've complied. It's self-compliance, self-reporting. So the professionals that are in private capital raising, they're a menu of them, some at the very high end, some are not so good. And it's very similar in many ways to the OTC market in that you have to be, as a purchaser of stock, on the alert. Let the buyer beware. An investor's on his own. They have to really be capable of performing their own due diligence. There is no SEC registration. There is no SEC comments. There is no exchange due diligence. There is no exchange, regulatory environment that makes it be, looked at very carefully by independent third parties to assure the integrity of the investment is working well. My little slide, which is when fleas go unchecked, because what I've analogized it to is, there may be pedigree dogs and then there are dogs with fleas. And the problem with a non-exchange environment is it appears as if it's all just dogs mixed in with dogs with fleas. It's very difficult to differentiate one company from another. Now, that being said, this one is one in which the buyer being aware, well, the buyer should always be aware. But there's a more macroeconomic feature to what is ordinarily been referred to as harmful effects. I use this expression all the time. What are the harmful effects that come out of this marketplace? And the macroeconomic feature is that, the markets are actually stable in a time of crisis because of regulatory oversight. And where regulators fall down, they often get blamed. But the fact is that stability in a marketplace exists. And it exists because regulators and stock exchanges which are self-regulatory bodies, are doing their job. Now, as I said earlier, all over the news right now, Silicon Valley Bank. They continue to hold, if you believe the news. So I haven't fully researched, I haven't looked at their balance sheet, but it would appear, at least from some of the statements that are coming out of the organizations that have now taken over the bank, that there's at least a fairly sizable portfolio of common shares in venture capital deals or unexercised warrants or some other form of share value that was on their books. So the current news stories that I've read said that they have classified non-marketable and other equity securities. So non-marketable. Well, as soon as you hear non-marketable, it means one of two things. One, it's an over-the-counter stock. All over-the-counter stocks are determined to be non-marketable. Or it's a private stock. Again, non-marketable, based upon what we just heard, right? So apparently, at the end of last year, this bank had almost $2.7 billion of non-marketable securities. Well, how they got them may be an exercise in regulator due diligence. And in fact, in some instances, whether they were allowed to own them at all might be a regulatory puzzle. But, it seems like in a $200 billion bank, that's a small portion. And in fact, there might be some extremely valuable companies and really good operating companies in which they did banking transactions with their venture capital firms and took back some of the interest. It's usually referred to as a sweetener. When a bank extends a commercial loan, it can and has the right to hold an equity position. It can hold preferred stock or warrants or some other sweetener so that extending the loan can be enhanced by the future success of the company to which they've loaned. So the fact is that it is this dog and flea separation that we're puzzled by right now. What I just explained was maybe there are some really good companies in there. Maybe not. Why does that question even exist? I can tell you why it exists, because those good companies are not in a marketplace. They're privately held. And I'm not demonizing private companies. Understand this. There are some people who have a very good private company. It makes a lot of money. They have no intention of inviting any partners into the company, and they operate and make a lot of money. Well, if that were the case with every single one of those companies, then probably the $2.6 billion we're talking about here wouldn't matter, right? Because those private companies would be so valuable that the valuable operating company with ease would be able to either transition to a new banking relationship or raise more money or just take some of their profits and make sure they survived. On the other hand, if that private company or over-the-counter company is teetering on the brink or really relying upon its relationship with Silicon Valley Bank to survive, well, those investors in the company don't know it. Now, the depositors of Silicon Valley Bank, they're very far removed from knowing anything about this. But certainly, Silicon Valley Bank may not have known it, in that the private company or OTC company wasn't in an exchange environment. So there might be significant underlying value, and they might be all very small companies, but had they had the option to move themselves into an exchange regulated environment and complied with the laws and were transparent, well, the one thing that's for sure is there would be a liquidity market. Those shares could easily be bought and sold in a stock exchange environment. Now, just as a final comment here, what's very interesting about the bank failure that just occurred, banks generally don't get taken over unless they have either exhausted or are in danger of exhausting what is known as Tier 1 capital. Those are the assets that a bank must hold that are the same as cash. And if they don't have liquidity and they can't recuperate that cash, bank regulators come in to protect the depositors. So if there was $2.6 billion out of $200 billion, it's an enormous amount, because the amount of tier one capital that a bank must hold is not very high. It varies. It can be as little as 10% of the overall value of the bank. If they were including any of it, towards tier one or tier two capital, and it's now determined to be non-marketable, not able to be converted to cash, and worthless, well, naturally the regulator has to come in. It makes for a ripple effect on the damage. Now, it would appear that Silicon Valley Bank didn't have that problem. Again, I'm reading the news. It appears their problem came because of spikes in interest rates and the lowering of bond prices. However, the ripple effect of that $2.6 billion upon the companies who were doing business with that bank and who no longer have an opportunity to be in a fair, equitable auction marketplace leaves them subject to whatever that bank regulator who's now taken over, whatever they have to say goes. Now, if we're in a position where recovery of losses is able to be utilized in the public market, and maybe there would be a sell-off. There are sell-offs in the market all the time. Perhaps there would be a lowering of prices. Well, if you choose a bad partner in your bank and your share prices go down, well, that is an actual effect on you. So it's like losing sales or losing a customer or any other actual business outcome. But if you're subjected to that and you're doing just fine, merely by virtue of the fact that you don't have a marketplace for your shares of stock, well, let me just say that the importance of having the marketplace to mitigate against these effects is very high for a small company. Small companies, and I have the pilot we did for the Dream Exchange many years ago, expanded its ability to use banking relationships from $3 million to $20 million in a healthy way, merely by virtue of the fact that they now were in a public market with accurate day-to-day valuations of their stock and their company, with quarterly reporting obligations to the Securities Exchange Commission. It just made banks that much more willing to do business with them. That company had its choice of banks. It wasn't beholden to single banks, oversight, which is where the oversight here is. The bank becomes the oversight of the integrity of the company, and it also bears the risk of whether or not that company succeeds or fails. This is a way of passing risk into the market to be absorbed by a broader audience of people, but it's mostly based upon actual business activity. Things have to go wrong with that individual company, not merely the overall economy. And when the overall marketplace has exchange regulatory rules in place, the stock exchange environment provides stability. In fact, a stock exchange can halt trading in a single security. It doesn't have to have one security determine the value of all others. It can halt trading in the entire markets, and has during times of financial crisis. Why? So as to protect what it might be a temporary, and temporary is a variable term, but at least a temporary reaction to something that causes a quote unquote panic. So the exchange sanity, the ability to have an independent outside organization regulating marketplaces, is a true stability feature during times of economic crisis. So having said that, one of the things we always cover is, the small cap company access gap. That is something, and you'll see this slide. You're probably familiar with this slide. It's been in multiple webinars. So how does a company actually access a stock exchange, national market environment, and be able to become a listing? Well, right now, here's our real harmful effect of not having a venture exchange and really not having an exchange with our purposes, which are designed, really our purposes are, how can we reach the small and mid-cap marketplace for IPOs? Well, for the effects on companies are really, you have to be a unicorn. You have to be a multiple $100 million or approaching a $1 billion valuation to avail yourselves of the public markets. And the liquidity that comes from an IPO and the value that comes to a company to expand is of enormous importance. It's probably more important in capital formation for a smaller company than it is for a larger one. Usually the larger ones are doing quite well. Smaller companies could use the expansion capital formation that might come from a public market, even if they're profitable. I'm not suggesting that they're in the concept stage or an early venture stage. The fact is that the companies that can avail themselves most of the benefits of this market are mid-cap, mid-market companies that are operating, that are working to expand, and they need access to capital in a large capital marketplace so as to assure that they have the initial and secondary liquidity. And access to that capital is, I say difficult, if not impossible. Listen, going private and raising capital privately is very difficult. I've been doing it for close to 30 years, and each time it's new and different. Sometimes it's easier than others, but it's always fraught with making sure that you have what I would call a Rolodex. Do you have relationships to that private capital? So the access to your capital is driven by relationships rather than by whether or not you have a great idea that can be worthy of the public marketplace and kind of democratized. People can vote with their pocketbook to invest in you. So those are harmful effects on companies. For investors, it's all about protection and transparency. So as the increase in our capital formation markets has gone private, really industry and the best deals go to the same people. So the wealth creation is in the same people. So the largest rewards for company growth tend to go to people who have already been successful. Not really even against that so much as there is a broader ability for an investor, especially a small cap, mid-cap investor, to see an increased number of companies on its menu. That's what a venture exchange would bring to the marketplace. But also for the investor protection features, everything I showed you in those early slides is what we would call regulatory oversight. And a stock exchange is of vital importance during that listing process to protect the investors. They want and need transparency in reporting of information. They also want it to be on a fair and equal playing field so that it's not merely a small group of insiders, but they have to comply and provide the same information to the market so an investor can make a decision side by side with everyone else based upon as much of the same information as is made available to the entire marketplace. And the last thing here is when I say unsure of their exit, I often say it this way. One of the primary questions that would always come up in every investment conversation I've had, I love the company. I'd love to invest $100,000. How do I get my money back? How do I get out? What will be the plan so that I can not only be paid dividends until the end of time, but how will we plan to recuperate the entire investment? Well, if you don't have enormous amounts of profitability being paid back to your investors, at some point or another, there's usually a decision of we have to sell the company. We sell to BigCo, or we do a management buyout, or we do a leverage buyout, or we do an employee stock ownership plan, or we sell to a competitor, or there's any number of features by which you can tell your investor they're going to recuperate their investment. But, in my business career, growing up as a kind of a child of the 80s, one of the common answers to the question was, we're going public. That isn't something anyone really says anymore. The answer to that question of we're going public can usually be, oh, really, you and what army? Because very few companies are going public anymore. In fact, in the last 20 years, when you look at, and I have a graph on this that you may have seen in other webinars, and I apologize for those of you who haven't been here, but we have an enormous amount of data that we've provided and continue to provide on this marketplace. In the last 20 years, fewer $50 million and under public offerings have been made than in any 1 year before 2000. Now think about that. There could be as many as 500, 700, or 800 initial public offerings that were $50 million and under, normalized in today's dollars, in any 1 year from 2000 going back decades. We haven't had that many in 20 years. primarily driven by the advent of financial technology and electronic trading. However, what's really important about what I'm saying as it pertains to our business plan is there is a way to re-stimulate that environment, to reinvigorate it. And that is by a custom marketplace. We need to have custom rules so as to benefit a company and make them willing to enter the market, assuring that there's regulatory oversight, while simultaneously giving the investor the opportunity to have transparency in its reporting and making sure that a fully compliant company is there to protect the investors, which gives the answer to the question, how do I get my money back? There's secondary liquidity. After the initial offering, just like the major markets, a venture market will offer the opportunity to resell shares in a stock exchange environment. That liquidity, for any reason or no reason at all, makes a venture marketplace extremely valuable to investors, eliminating one of the most harmful effects on the investor, which is once you make a private investment, you're in, and you're in for the duration until the company leadership decides to sell. So the fact is that the harmful effects for companies and investors are very easily articulated. But lastly, and this is kind of what I've addressed in these earlier slides, there's a capital market system. There's an entire ecosystem that exists, bringing companies along the journey towards graduating to be large enough to be in a national market system where your shares might be traded in millions or billions of a second. Well, before that, they need to be in a more custom marketplace so they can graduate. So upon our capital market system, that liquidity for small companies, it gives both the company liquidity and it gives the small investor the ability to have liquidity, protecting the marketplace from instability because there's trust and transparency in reporting, and there's exchange oversight of each individual company as well as the market as a whole. So the solution that we've talked about for a long time, I'm giving significantly more detail because quite a bit has gone into development of this marketplace from our team. And the fact is that we know that our solution is a square peg in a square hole to help mitigate against, lessen, or even eliminate altogether in some instances the harmful effects on small company access to public capital markets. Now, we're going about this in about a 5-phase process. So in this process right now, if you look at this as a kind of a backward planning, you'll see that phase 1 here is at the end, right? So if you're going from left to right, which is how reading the English language goes, we have to start on the right side. So phase 1 is becoming the first national market stock exchange with substantial minority corporate participation. Now, this doesn't just mean the ownership amongst the minority community, because we're going to be 50.1% Black owned as an organization. But when we say participation, that means participation by minorities on the board of directors, participation by minorities in senior management of the organization, participation by having a broad and diverse workforce. And also the 5th one, I think, which is most important, which is dedicating ourselves to development of markets where they haven't been developed before, to create prosperity in minority communities and address that issue. And those 5 factors really go into the expression minority corporate participation. And this, while increasing that opportunity, what we've done already, and I'm going to announce this here, we currently have completed our fully functional live stock exchange technology. Now we're not live yet for purposes of being an exchange in which you can bring listings to or actually carry the traffic of trading. But the exchange technology and innovation that we've put there is now live in the data center alongside the other stock exchanges. We actually have completed trade execution in our mock environment. We're now continuing to test the exchange, but our stock exchange, the Dream Exchange, is a functioning electronic stock exchange sitting in the data center. I have to check on how much I can disclose about where it is and where our backup systems are, but suffice it to say, there's hardware, software, and infrastructure in place. The Dream Exchange, as of today, exists as a fully functioning stock exchange, ready to accept orders from customers, which we will be going through the remaining process to obtain our license later this year. So phase one is very close to completion in our business plan. So the phase two is to develop listing rules. And now listing should have a significant meaning to you, different than registration. We're developing our listing standards and rules so that we can accept candidates for IPOs on the national exchange. So once licensed, the next phase will be publishing these rules with the Securities Exchange Commission and beginning the process of inviting companies and actually major investment banks to bring their listings to our exchange. That's phase two. And this is a reverse sequence. So phase one must be done before phase two. Phase 3 and 4 are the development of the venture exchange model. Now we have entire webinars dedicated to that process, which includes a legislative process. But here's the interesting feature of 3 and 4 at this point. With the completion of the technology of phase 1, we now have a complete routing system, order book, trade matching engine, and the ability to use databases that will be utilized to be leveraged from our existing platforms for venture exchanges. So the time to operational venture exchange has been dramatically reduced and in some cases eliminated by virtue of the fact that our NMS exchange technology is in place. In addition to that, however, we also have to develop the listing market for venture exchanges, which is a brand new market. It doesn't even exist at this time. So within the walls of the Dream Exchange, in the future, we'll be publishing more and more information about eligibility to get into that marketplace. And the last phase, which is actually kind of simultaneously going on, doing what we're doing right now, creating market acceptance and growth by educating the public on public markets, public access to public markets, and even to the point of creating what we consider our public outreach programs for not only financial literacy in the sense of, what would be elementary education, which we intend to do in the future, but really grooving in and getting venture capital firms, small angel investors, and small companies the information they need so they can actually join the group of venture companies on our exchange. So without educating the market, it's going to be very difficult for anyone to truly understand what we're doing, how we're going about doing it, so they can actually join the market. So this component has been ongoing for many years. We're actually delivering, fundamentals of the market in easy to understand terms, so entrepreneurs and early stage companies are able to actually access this market when it goes live. And you can see here that it's kind of like stairs. So what we're hoping for is that the educational process will lead to the venture markets in the ecosystem, and that the venture markets will grow companies and allow those companies, once they're fully mature and able to really participate in the national system, that they graduate from the venture market system and are side by side all the other companies that are large public companies and expand the prosperity that they've created from their birth. So it's a gradient process by which the ecosystem can be restored and reinvigorated and brought back to life. So, and I think I may have, oh boy, I made it. Usually I go over, I try to limit this to about an hour, but I do have 5 minutes. I'm going to go in and I'm going to check in our room because what I have next is some question and answer. My team usually goes in and prepares the questions and things that are there that, let me just check. They summarize them. Okay, good. So actually, let me start by saying this. I want to thank everybody for the cheerleading. um, I love when we deliver these webinars and people are actually asking questions, and but when the questions turn into, we think what you're doing is great, and thanks for really investing in what is the future of our country. It's kind of our paycheck. It's really the purpose of doing it. But I have a more specific question. Wait, let me try to read this question. Sorry, the glasses need to come out. Oh, this is a good question. So how do we avoid being affected early or first when the market environment is negative and the last to recover given recent events surrounding banks heavily involved in the VC groups? So good question. And actually the question is twofold. First is, generally now don't take this the wrong way. Stock exchanges make more money when stocks sell. The fees a stock exchange earns when a stock is sold are higher, and sometimes when a stock is purchased, the buyer isn't charged the fee at all, or sometimes given a rebate. So when you see a sell-off in the market, it's actually more profitable for a stock exchange in many respects. So selling a bear market can often result in, as long as there's volume in the bear market, stock exchanges tend to flourish. So that being said, economic crisis and a lot of volatility usually means profitability for a stock exchange. On the other hand, the sub part of the question is, how do we make sure we're ahead of the curve in terms of policing the market? Well, the answer to that is twofold. One is, it's a regulatory question that is standardized amongst exchanges. So it's not as if we could individually as a stock exchange decide to single out a company all by ourselves. When this is occurring in the national market, if one company has a 80% drop in its market value in a single afternoon, there's going to be regulatory triggers. There are actually mechanical devices within the exchange that trigger a halt in trading. There's also trading halts of the overall market that are triggers. So it's an electronic trigger, so that it's not like we are sort of sitting there with a pencil and paper going, oh, that's too much, that's too little. They're built-in mechanics to the exchange system that require us to police according to the rules and the National Market Plan in conjunction with the SEC and the Department of the Treasury so that the economy remains safe. Now, that's a little different in the venture marketplace. A venture exchange, once launched, is a silo. What that means is the listings on a venture exchange are unique to each exchange. In other words, if a company approaches the Dream Exchange to list its shares, no other stock exchange is involved with that listing but us. We own a monopoly on each venture listing. Therefore, it falls entirely on us to make sure that the triggers are in place and set properly to make sure that the venture market listings will not be abused by market participants or bad behavior. We won't be able to look around and see, oh, did all the other exchanges have the same trigger? And generally they do. In this market, we will be establishing our own rules with our own triggers that will either determine that that individual security has to have a halt trading or the market as a whole does. So it's a very unique position to be in, and the license is very different. So there's another question here, the license for the venture model. So yes, there's two license processes. One is the National Exchange, which we're like a speeding bullet for the National Exchange. That is, it has a momentum right now. Nothing can stop it. As long as we do the work, we'll see ourselves open. On the other hand, the venture exchange marketplace has really two barriers that are in the future. One is, and we're still working on this, the fact is that we're poised at this time, very early in this new Congress, to swiftly see the legislation through. So it has to have a legislative feature. Once the legislation passes, which I believe at this point, it's a matter of when, not whether. So we're working on the when, because it has been unanimously voted on in Congress before. And absent the historical politics of the past, where we really just were swept up in that with all other, I would call it baby and bathwater situations with a lot of good laws that just didn't get passed like us, merely by virtue of the fact that nothing was being introduced into Congress. Well, this is a different setting because this is very much going to be an environment where the necessity for this law has now reached critical mass. So the interest and level of moving it forward is increasingly getting higher. So that's the first barrier. The second barrier to the venture exchange marketplace is a separate license. On the other hand, and I'm careful about the way I say this so as to not offend members of Congress, the venture exchange legislation called the Main Street Growth Act is about 11 pages long. It started out as 4 pages. There was an 8-page amendment, and I was one of the primary people drafting that amendment and making changes to it. Therefore, the exchange license requirements, which the SEC is going to be helping design, we're going to be weighing in very heavily on exactly how that license is obtained and how it will work. As one of the people who helped design the laws once passed have to be given proper congressional intent in the regulators. And I'm intimately familiar with the intent of the law. So when we're looking at legislative intent for how the license will work and how the rules of the exchange will work, I think we'll be among the first, if not the first, company to operate a venture exchange. I've also built in to the law specific time periods by which the SEC must grant the license. So whereas a Form 1 application for a national exchange requires a very lengthy process, which we're preparing for and are in, and it's a little bit discretionary where the SEC can sort of take its time if it so chose. That isn't the case with the venture legislation. So venture legislation is not a Form 1, it's a Rule 19 amendment to your existing license. So it's an added part of an existing license, which we will already have. So that's one feature that will speed things along. The second thing is that I've already formulated what I believe are the fundamentals behind the listing process, which needs to be formalized. There's a lot of work yet to be done, but formalization of our listing process, as well as making sure that the parameters around certain trading rules are in our rule book. And those parameters it's very different. It's a very different market than the national market. For example, in the national market, once a security is listed on an exchange, it must be offered constantly. It means that all day, every day, the security must be available to be bought and sold. In the venture market, we have the right to have what's called a periodic auction. So in the legislation, it says an exchange can determine whether a security is traded every day, whether it's traded twice a week, once a month. We get to have periodic auctions. There are other similar rules that make it available to us to design protections for the companies and the investors. For example, we can determine what's called the tick size. At what price change in a security must a trade be filled? Right now, it's 1/10 of a penny. So as those prices are changing constantly in the national market, we can decide to make it much higher. We can also decide the volume-based constraints on shares. We can decide exactly what the listing parameters are. We can decide what due diligence process the company must go through in order to get listed. So there's a whole series of new and different rules that have never been applied before. Some of them are based upon fairly accurate historical data. On the other hand, some of it's new. And we think we have a pretty good hand on what the development that will look like in the future. How far have I gone? So I've gone 6 minutes past. So what I'm going to do, I'm just seeing, thank you again. Thank you for the amen, whoever wrote amen. So what I'd like you to do now, however, is if you click on the offers button, click on the link at the right, and there's a form to fill out. We're I was talking to the tech team this morning, and we like Webinar Jam. It's been a good software for us, but sometimes the Webinar Jam gets jammed in people being able to confirm and get into the webinars. So right now we're not putting out our next webinar link because we might actually change our software. So if you do this, if you fill out the form and make sure that you're in communication, and I welcome the communication, by the way, everyone, email us. Our senior management team answers and talks to you. I've talked to people from webinars. Please be in communication, because your voice is important to us. We're trying to give the greater American public a voice in the public markets. So please be in communication, talk to us, follow us on social media and LinkedIn, and email, so that you can make sure that you get an email for the next upcoming webinar. It's in the offers button at the right. And lastly, once again, I just want to thank everyone. I'm about to lose my voice. This is very important to our whole team, that you are there prospering, succeeding, and really being able to come and join our group and use the Dream Exchange for its intended purpose, to make sure that we instill prosperity in our nation. So please join, please come along, email us and stay in communication, keep following us. Your support is very valuable. We really appreciate you actually participating in every webinar. And there's a whole team of people behind that. So in the meantime, please stay well, stay healthy, keep yourself safe, be prosperous, and we look forward to seeing you again very, very good, very soon. Oh, wait, one last thing. Oh, thank you. I can't read the name of whoever wrote this, but exactly as I'm saying, thank you for leading this most important movement. You're very welcome. That's my paycheck right there. Thank you for your sincere appreciation, and back at you. So everyone, like I said, be well. We'll see you again very, very soon. Stay well and prosper. Thanks, everyone.